Okay, and this is the introduction video to the Unit 3.5, which is monetary policy. Now, before we start, there is a distinction that I do wish to make in that monetary policy can eventually, in the long run, affect long-run aggregate supply and aggregate supply itself, but that is not the intention of it. The intention of monetary policy is to affect aggregate demand for reasons that we'll see in the next slide, and as such it is one of the two demand side policies. So there's fiscal policy and there's monetary policy. Right now we're just doing the introduction to monetary policy. Okay, so like everything in economics, the most important thing that you can do to help your study and help yourself achieve a high grade is have an innate understanding. Know what you are talking about. Yes, there will be things that you'll have to learn off, and there's a few definitions that you'll have to learn off word perfect in this presentation, but it's very important to understand what you are saying or what you're trying to explain in your answers in your IB exam. Now, this is my definition. This is not something that I ever would advise you to write down, but the only reason I'm giving this first is so that you understand what monetary policy is. Now, again, just a quick digression. I will explain later in later videos how interest rates are determined and how they're affected by money supply and money demand. Right now, I just want you to accept what I'm saying as true, and then once you kind of get an idea of how monetary policy works, we'll go deeper into the weeds and explain the mechanism through which monetary policy affects aggregate demand. Okay, so monetary policy is a way that a central bank, you don't know what a central bank is yet, but we'll talk about that in a second, is a central bank tries to achieve economic objectives by changing the amount of money in the economy, which changes the interest rate, which changes aggregate demand. Okay, so that's the first thing. So, how does the central bank, you don't know what that is yet, just essentially it's a government bank, how does the central bank try and achieve these economic objectives down here? Right, well, the first thing it will do is it will change the money supply. Now, that change in the money supply, and you don't know why yet, will change interest rates. That change in interest rates, and you should know why a change in interest rate or how a change in interest rate affects aggregate demand. So the changes in interest rates will affect aggregate demand. Okay, now when they're still trying to achieve economic objectives, but when they change aggregate demand, that is how they are trying to achieve these economic objectives. Okay, well, what's the economic objectives? What are the economic objectives? Well, one of them is stable economic growth. So they don't want a runaway boom economy, and they don't want a depressed bust economy. And what they would like to happen is stable economic growth every year, trying to smooth out the business cycle. Okay, so what would they have to do with aggregate demand to do that? Well, it depends what's happening in the economy. If it's going through an economic boom, they may wish to reduce aggregate demand if it's unsustainable and beyond the sustainable point, the LRAS curve, where Y is at full employment, YFE. If there's a depressed economy, they may want to stimulate aggregate demand in order to increase economic growth. Low rate of unemployment. What would they have to do if unemployment was too high? Well, they'd want to stimulate aggregate demand. Low and stable inflation. If inflation is too high, they may wish to reduce aggregate demand. If inflation is too low, they may wish to cause some inflation and as such stimulate aggregate demand. And always to reduce income inequality, to increase income equality and reduce income inequality. So looking at all of these things, what I want you to know right now is that the central bank will change the amount of money in the economy. I'll define that better in a later slide, which will then change interest rates, which will change aggregate demand with the view of achieving some of these economic objectives. Don't forget, these are all four. Okay, so let's get deeper into the things that you do need to learn off word perfect. So the central bank, the first thing about the central bank is it's the government's bank. Okay, so all payments from the government and all receipts to the government would be made by or into this account, into this central bank. And it's the institution that is responsible for an economy's monetary policy. So the definition of central bank that you just learned off word perfect, the government's bank, the institution that is responsible for an economy's monetary policy. Okay, well, what's monetary policy? It is a demand-side policy using changes in money supply or interest rates to achieve economic objectives relating to inflation and unemployment. Now, that is this is the one you learn off, but that is so similar to the one that I've given in the previous slide. And what I want you to understand is the first thing that they will do, the central bank will do, in order to enact a monetary policy, whatever it may be, expansionary or contractionary, is they will change the money supply. That then changes interest rates. That then changes aggregate demand, and that then hopefully achieves an economic objective, particularly inflation or unemployment. And that's all I need for the moment on monetary policy. Now, I have kept on saying a few things, and one of them I've said money supply. Okay, so we better define that. And this is again something that you have to learn off word perfect. Okay, the total value of monetary assets available in an economy at a specific time. Now, I will give you an easier way in a second to think about money supply, but if you are ever defining money supply in a question, particularly on monetary policy, this is the definition you give. Okay, well then another question is, what's money? Money is anything that is generally accepted as payment for goods and services. Now, I don't want to go too deep into the distinctions of this idea called near money and so on and so forth, but what we are going to do now is give a very simplistic view, a way that you can clearly in your mind calculate the money or the total amount of money in the economy, which is essentially the money supply. What we will say money is all cash in circulation. I'm not talking about cash in bank vaults. I'm talking about notes and coins, depending on where you are in the world, of course, but notes and coins that are in people's pockets, people's wallets, people's purses, whatever. That is part of the money supply. And then the next part that we would add to that, and we can just find out figures, they'll never be asked to calculate this in an exam, of course, but just so you know. So it's all the money that's out in the economy, in people's pockets, wallets, purses, whatever. And we're going to add to that all money in checking accounts. Now, it depends again on where in the world you are, all right? But where I'm from in Ireland, we would say a current account. In America, I believe they say a checking account. And what that is, a current account or a checking account, is an account that you can make payments from. Okay? Now, the reason that I make sure that that's really, really important that you understand that right now is because a savings account is not included in at least our definition of the money supply. We're measuring the money supply as what's called M1. Okay? So what we're saying is the total money supply is all the money in circulation in the economy. It has to be out in people's pockets, wallets, purses, whatever. And then also combined to that, all the money in checking accounts or current accounts, not in savings accounts, because you cannot make payments from a savings account. And therefore, money is anything that is generally accepted as payment. So that doesn't count in our definition, M1, of what money is. And again, what I really, really, really want you to understand is that a change in the money supply causes interest rates to change in the short run. You don't need to know how yet. That will be in a later set of videos. But right now, a change in the money supply causes a change in interest rates. And you should already know that a change in interest rates causes a change in aggregate demand. And the central bank is the government's bank that's responsible for enacting monetary policy to change, with changes in money supply and interest rates, to change aggregate demand, to achieve an economic objectives, usually unemployment or inflation. And the reason that they would do that, the reason that they would change the money supply is to change the interest rate, is to change aggregate demand, and then change in order to achieve an economic objective. Okay, that is the first video on monetary policy. I really, really hope that helped. All I want you to understand now is that changes in money supply causes changes in interest rates, which cause change in aggregate demand, which is done in order to achieve an economic objective, and monetary policy is enacted by the central bank. Our definition of money supply is all the notes and coins in circulation, and then the total added together aggregate balances of all checking or current accounts in the economy. Thanks very much.